from Group 4, and right now we will like to presentation about credit risk management. I am Laras Azhar Widyasari as a leader of this group, and here we have...
I'm Nadia Yundani.
I'm Rizka Milenia.
I'm Mutiara Haripangestu.
At this time, illegal online loan fintech applications are booming on social media with various attractive offers. With only an ID photo on the online loan application, we can get the loan we want. What we have to apply in our minds is that we shouldn't be easily tempted by the lure of the ease of applying for these loans. We have to find out in advance whether the loan application is real or just a scam. Because apart from that, there have been many cases that the contact on his cell phone can be accessed in any way and then humiliated by contacting all those who are contacted by the borrowing customer to tell his friend that the borrowing customer has not paid his installment and ordering his contact so that the borrowing customer immediately pays the installment. So to minimize the cases like the one above, credit risk management is needed so the credit cases do not occur again. So before we straight to the main topic, we have to know definition of credit. Credit is the provision of money or an equivalent claim based on a loan pay agreement or agreement between the bank and another party, which requires the borrowing party to pay off its debt after a certain period of time with interests. Next, things that are included in credit risk. Lending risk. The risk in because customer are not be able to pay off the mortgage by the bank. The second, counterparty risk, is the risk where the counterpart is unable to pay off its obligation to the bank either before the date of the agreement or on the date of the agreement. Issuer risk, which is the risk that the issuer of a securities cannot pay off to the bank the amount of the value of the securities owned by the bank. Next, definition of credit risk management. Credit risk is the risk arising from failure or default of a counterparty to meet its obligation. Credit risk is also a loss related to the possibility of failure or default of the counterparty to meet its obligation or the risk that the debtor will not repay the debt.
Keys in credit risk management. The 5 C's of credit is a system used by lenders to gauge the creditworthiness of potential borrowers. The first C is character. Although it's called character, the first C more specifically refers to credit history, a borrower's reputation or track record for repaying debts. This information appears on the borrower's credit reports. Banks need to know the borrowers and guarantors are honest and have integrity. The second C is capacity. Bank wants to know that your business is able to repay the loan. The business should have sufficient cash flow to support its business expenses and debts comfortably while also providing principal salaries. The third C is capital. Bank also consider any capital the borrower puts toward a potential investment. A large contribution by the borrower decreases the chance of default. Borrowers who can place a down payment on a home, for example, typically find it easier to receive a mortgage. Even special mortgage designed to make home ownership accessible to more people, such as loans guaranteed by the Federal Housing Administration or FHA. The fourth is collateral. Bank will consider the value of the business asset and the personal asset of the guarantor as a secondary source of repayment. Collateral is an important consideration, but its significance varies depending on the type of loan. The 5C is condition. The condition of the loan, such as its interest rate and amount of principal, influence the lender's desire to finance the borrower. Condition can refer to how borrower intends to use the money. Consider a borrower who applies for a car loan or a home improvement loan. A lender may be more likely to approve those loans because of their specific purpose rather than a signature loan, which could be used for anything. Additionally, bank may consider conditions that are outside of the borrower's control, such as the state of the economy, industry trends, or pending legislative change. And then we have 5P principle. The first P is party, grouping or classifying debtors into several groups. And the second P is purpose. The purpose of the loan should be explained in detail by the borrower. The bank needs to know how exactly the money will be used. For example, if the loans for home improvement, the borrower should be include a description of the exact renovation covered by the loan. The third P is prospect, predicting and assessing the debtor's business in the future if the loan is carried out to run the business or business by the debtor. And the fourth P is payment. Payment includes all of the means that a borrower will use to repay the loan. This shows the bank how they will recover the loan as well as the interest. It often includes a borrower's incomes as well as insurance policies. The fifth P is protection. Protection refers to something the borrower pledges to the bank as a guarantee that the loan will be repaid. If the borrower fails to repay the loan as it's defined, the loan is considered in default and the bank can take possession of the collateral as payment. And then we have three R principle. The first R is returns from the investment. This principle is related to the ability to bring success from loans to debtors. The second R is repayment capacity. This simply means the ability of the borrowers to clear off the loan obtained by production purpose within the time stipulated by the bank. And the last is risk-bearing ability. It is the ability of the borrower to withstand the risk that arise due to financial loss. Risk can be quantified through statistical technique like coefficient of variation.
Credit collectibility. Quality 1. Current credit. This means that the debtor always pays debt on time. Is the high quality collectibility status belonging performing loan the person a good customer because always paying off his credit. Quality 2. Under special mention, the debtor is in arrears in installment payment from 1 up to 19 days. Quality 2 is marked by late payment of the debtor exceeding to the debt up to 19 days from the due date. In the banking practice, generally quality 2 by the bank has been considered bad because it relates to customer character problem. Troubleshooting non-performing loans with quality 2 status can be done sharply. Quality 3. Substandard credit, the debtor is in arrears in installment payment of 91 up to 120 days. Quality 3 represents the quality electability of the debtor who is late paying more than 19 days from the date of his monthly maturity up to at least 120 days. In this case, the bank is required to issue a warning letter. Quality 3 has started including non-performing loan credit. Quality 4 is doubtful. The debtor is in arrears in installment payment of 121 and up to 118 days. Quality 4 is a quality electability status that signifies a late payment of more than 120 days from its due date. At its stage also, the bank is obligated to issue warning letter to the debtor. Quality 4 is called non-performing loan. Quality 5. Not working. Debtors are more than 118 days in arrears in installment payment. Quality 5 is lowest quality electability classified and non-performing loan, which represent principal installment and unpaid credit interest, and the bank is obligated to perform the most recent problem solving of the problem quality lateral auctioning. Credit risk mitigation. Avoid the risk of credit proposal reject. Proposed loan include the prohibition of credit financing. Prospective borrowers are included in the list of bad debts. And reducing of risk of syndicated loan, asset house credit, hedging foreign currency loan. Transfer risk, credit insurance, and risk participation. Accepting risk, small business financing, and mass product. Next. I will tell some important things about credit risk management. Role of credit risk management and relationship management. Official of the banking institutions, and other business that are responsible for credit decisions that in practice create conditions of a controlled and safe part of CRM and RM. And the next, quality credit agreement able to minimize the risk. How to minimize the risk? The strongest credit agreements, namely agreements between creditors and debtors.
Credit risk for investor. Those who have a financial surplus will tend to put money in place that were able to provide comfort in the form of profit and security, such as savings, deposit, and bonds. So that when credit risk occurs, there are several problems that will be faced by investor. One, investor will experience delays in receiving profits in the form or interest or capital gains because the banking condition is express financial distress due to the large number of debtors who are not on time to pay credit installment. Two, for bondholders, the problem becomes bigger when the issuer is in a state of bank corrupt and is ready to be liquidated. Three, the delay in receiving the profit from each interest causes problems with external parties, such as if the bond and deposit holders make purchase on debt basis, assuming the debt payments are made by taking into account the maturity date of receipt of bond and deposit interest. Those who have a financial surplus will tend to put funds in a place that is able to provide comfort in the form of profit and security. In fact, investors should be aware of some other risk factors affecting corporate bonds. Two of the most important factors are call risks and equity risks. If a corporate bond is callable, then the issuing company has the right to purchase or pay off the bond after a minimum time period. Next. Default risk is the risk of default a number of credit loans borrowed. The cost of debitus is not able to repay the loan in untimely manner due to unstable macroeconomic conditions, company loss due to decreased sales, corruption in the company cause a decline in company value in the eyes of the public, mismanagement occurs. Default risk is also called defaulty probability. Is the probability that a borrower fails to make full and timely payments of principal and interest, according to the terms of the debt security involved. Together with loss severity, default risk is the one of the two component credit risk. While is it often useful to consider that well distribution of potential loss and their respective probabilities. It is generally convenient to calculate a simple indicator of risk to consider a single default probability and loss severity. Next. Policy and solution to avoid default risk. Condition of the occurrence of default risk has a risk both on the part of the debtor. So to avoid this default risk, there are several actions that must be taken, namely, A. For creditors, it will increase the guarantee number to a truly safe level. B. Avoiding guarantees that have a level of risk assurance so that accepting the objects as collateral will actually cause the company to experience difficult in the future. C. Avoid collateral that has fluctuating value in the market. Banks as creditors try to avoid bad credit because the smaller the bad credit, the smoother the cash flow from the credit that goes to the bank. Thank you. I think that's all from our presentation. Wassalamualaikum warahmatullahi wabarakatuh.